valuation, intrinsic value, related value, and all the other complicated stuff before we even start on the DCF. So, what exactly is a DCF? Okay. Uh, Typically, when an interview asks you how do you evaluate a company, there's two ways of doing it. There's two values. There's intrinsic value and there's relative value. Intrinsic value is basically the DCF method or the income method, I think. And basically, you are using you're projecting out the future free cash flows of a company, then you're discounting it back to the present value. That's what the intrinsic value is. Okay. Relative value, on the other hand, typically finds a universe of comparables, which is basically companies that are very similar to the target company, and then you're benchmarking them, benchmarking their performance, and then you're finding a tight median range where you can evaluate the target company. That's relative value. So you can see that the relative value kind of has the market into it, consider into it the market fluctuations along with the competitors, whereas the intrinsic value is more based on the book and more academically driven. You will have a lot more investment bankers lean towards comparables. They'll also do DCF for sanity check, but they'll lean towards comparables for value. Whereas I think accounting firms kind of lean towards DCF, since it's much more conservative, I think. So let's get started. So like I said, intrinsic value is the projecting out the free cash flows in the future years, then discounting it back to its present value and adding those present values up. That is basically what the intrinsic value is. So let's just say you're projecting out a company's, you're using a 1 to 10 years, so about 10 years period in your DCF analysis, which is typically the case majority of the times. You're going to discount the free cash flow for every single year up to 10 years, and you're going to bring it back to its present value, and you're going to add all those present values up. Okay, so that's one portion of the present values. The second portion is you have to find the terminal value, and basically the terminal value says that, okay, after I even look at the free cash flow of these 10 years, when most likely the company is still going to exist after that 10th year. For example, if we do a valuation on Walmart for the next 10 years, what's the probability that even after that 10th year they're still going to exist, they're still going to crank out free cash flows? A high probability, right? Well, we need to measure those free cash flows in the future. So what we use is a perpetuity and growth formula, which you see here. This is your terminal value, this is your free cash flow, this is your growth rate, this is your discount rate or WACC rate, and this is your growth rate. Okay, and like I said, the terminal value basically finds the value of a company after its projected period and discounts, and that's called the terminal value. Then we discount that to its present value. Okay, are you with me? So now we're gonna take this terminal value, the present value of the terminal value, and we're gonna add it to the present value of all the free cash flows that we have found, and altogether we value a company. We find the enterprise value, which is typically the valuation of the company. Okay. Sounds a little simple, but deriving out the WACC is probably the hardest part, in my opinion, and kind of interpreting these formulas. Whereas over here, let's say you have projecting out 1 year, so you're gonna have cash flow for 1 year, and you're gonna take to the power of 1. If you have, let's say, 5 years, so you're gonna have the 5th year free cash flows, but at the bottom is gonna be to the power of 5. Okay, so the exponent is going to be 5. So keep that in mind, okay? So I covered that. Now, these are the calculations that we need to keep in mind whenever we're playing around with the DCF. Number 1 is free cash flow. How do we find free cash flow? Okay, free cash flow is basically your operating profit, also called your EBIT, multiplied by then you tax affect it, like you see here, 1 minus tax rate. Another way of thinking of it is basically after tax operating profit. Okay, that's another way of thinking of it. Cool. So after you get that, the tax affected EBIT, also called EBIT, you add back depreciation and amortization, and then you're gonna subtract change in working capital. So what's change in working capital? Well, change in working capital is essentially majority of your current assets and liabilities. These are your working capital. Okay. Now, don't get this mistaken with just working capital that you get out of the balance sheet. We're not looking at these formulas. I mean, we're not looking at these numbers. Okay. Okay, we're not looking at these. We're trying to find the change in working capital. So what we do is that that change is going to be shown in the cash flow statement. So we go to the cash flow statement and we find our working capital right here. And this is the change that they have. Okay? So we count in the change in working capital. Okay? And minus capital expenditures, which we also get out of the cash flow. Okay? Keep in mind where your free cash flows, you get everything out of the cash flow statement except for the EBIT and your tax rate. Okay, I think that's the easiest way to remember it. Second thing that we have to keep in mind is the required rate, WACC. Okay, what exactly is the required rate? Okay, let's just say that you're an investor and you are thinking about investing in company A or company B, right? And you want to know, okay, which company is going to give you the highest return, right? Okay, which return, or basically, if you're thinking in more economics terms, which company has a marginal benefit that's higher than your opportunity cost? Okay, so what does that mean? Your opportunity cost is you are putting your money in one particular investment, and you need to know if that investment is working at its most efficient level, right? So that's your opportunity cost. And your marginal benefit that you want the marginal benefit to be is a particular rate, the return rate that you're looking for. Okay, so that's basically what the required rate WACC is. The higher the WACC, the higher the WACC, the more volatile the stock is or the deal is, I guess. So keep that in mind when you're thinking about the conceptual basis of the WACC. Okay, so how do you get the WACC? Well, we get the WACC on two bases. First is the debt side and then the equity side. We want to find out the required rate both for lenders and investors. Okay, so how do we do that? Well, you see here for the debt side we use cost of debt. When I say cost of debt, that means what is the return cost of debt, not exactly the whole debt value that you're going to pull out of your balance sheet. No, that's not it. You're basically finding the return on that debt. In order to find the return on the debt, you usually go in the market like Bloomberg or Thinkorswim, and you look at year to maturity corporate bonds that are very similar to the targeted company's bonds, right? So then you find that when you find that yield that's very close to similar to your target company, you're going to use that yield in the cost of debt. Okay, then you're going to multiply by its tax shield. Okay, and the reason you multiply by tax shield is because interest expense is tax deductible. Okay, keep that in mind. Interest expense is tax deductible. That's why we have 1 minus tax rate over here. Then we're going to multiply it by the capitalization of debt, which is just like a geeky way of saying the proportion of debt from the whole capital structure, which is debt plus equity. Okay, so that's the debt side. The cost of on the equity side, cost of equity, which is called return on equity. The cost of return on equity, not exactly the equity that you pull out of your balance sheet. You take that, and I'll give more detail exactly you find it. Right. So cost of equity multiply the capitalization of equity, which is proportion of equity over debt plus equity. Okay, now you're gonna ask yourself, like, okay, why doesn't cost of equity have a tax shield just like cost of debt? Well, think about it very closely. We said that interest expense is tax deductible, right? Um, corporate, we call it, with the equity is not tax deductible. I mean, let me show you why. Okay, this is our financial statement model. Okay, this is our income statement, and you see that interest expense is over here, right? Well, the rule of thumb is if it's before taxes, that means it is tax affected. Okay, that means tax has somewhat of an effect on it throughout the income statement. If it's after the tax, like we see with common dividends, and we also see with the basic EPS, that is typically not common dividends. Well, this is gonna sound very, very odd, but it's not really tax affected. It doesn't really consider it into tax. Okay, so you're probably asking yourself, like, wait a minute, like, isn't common dividends or corporate dividends like double taxed or something? Yeah, net income is taxed. Okay, not common dividends. Common dividends is just a random number out there, basically, right? A company decides to give dividends and they have this much, right? Net income is the one that's taxed, and once you pay out the common dividends, that's double taxed. Then that's taxed again. Okay, so keep that in mind. So that's why we don't have a tax shield in the cost of equity side. Okay, now like I said, I want to come back. How do you get cost of equity? Well, cost of equity is not as straightforward as the cost of debt. And the cost of equity, basically, there's different methodologies you can use, but one of the most common ones that is used on the street is capital asset pricing model, your CAPM. You've probably heard of this. The CAPM basically considers two types of risk: unsystematic risk and systematic risk. Unsystematic risk comes about when your lack of diversification, basically you put all your eggs in one basket, you invest all your money in a particular company. That's unsystematic because that's risk that comes inside when you do not diversify. Okay? Fortunately, that risk can be eliminated through diversification. The second risk is systematic. And systematic risk is basically you just being participated in the market. You just putting your money in in the stock market is a systematic risk, because you can still lose money even if you put the when you put the money in there, right? In the stock market. So that's the risk that the CAPM tries to measure, right? And the way it tries to measure is that it takes the risk-free rate plus beta multiplied by the market premium. This is whatever is in the parentheses is the market premium. Okay, so how do you get risk-free rate? Well, the risk-free rates, basically the whole significance about the risk-free rate is that what is the most safest investment that you can get out of the market, that you can use as a proxy when it comes to risk-free. Typically, they're very close to being risk-free. Well, over the time, we have considered the 10-year Treasury bills to be, because of their lack of liquidity, to be considered the typical risk-free rate that we consider in our CAPM. That's why in the news, the CNBC and everything, you always hear them talk about the 10-year bills, possibly about the 30-year bills too, because every single company, when they are going to go in an M&A deal or evaluating a company, they will use the 10-year T-bills to calculate their CAPM. So that's how they got their risk-free rate. Now your beta is basically, I want to say the amplification of variability, basically. For example, if you have a stock and they have a beta of 1, okay, that means when the market moves up 1 point, I guess, so this is 1 point, then that means that the stock is going to move 1, because it's 1-to-1 proportionate to the market. So when the market falls 1 point, then the stock is going to fall 1 point. Now, what if our beta was 2? What does that mean? Well, when our market goes up 1 point, our stock is going to go up 2 points. You get it? So that means our market is proportionate to twice our stock market. Our stock, okay? So, in the other way around, if the market falls 1 point, then the stock is going to fall 2 points. So obviously, you do not want a very high beta, especially a very high negative beta, because that just tells you that's a lot of negative onto a company, right? So that, and betas are found on Barra or Bloomberg, and they're levered industry betas that we're going to use since they're most accurate. We try not to use historical betas because they can distort the future of the company, their valuation. So the best way to go about doing this is trying to get industry betas, which we'll go into how exactly you do that. Okay, and this is your market premium. And your market premium is basically your return on the market minus your risk-free rate. We already talked about what's your risk-free rate. That is your 10-year TB bills. I mean your TBs, basically. Your return on market is going to be your S&P 500 return. Okay? Altogether, is going to be called the market premium. Another name for the market premium, in this case, is going to be S&P 500 spread against the 10-year TB bills, right? Now, the reason I say that is because your return is S&P 500 and your risk-free rate is 10-year TBs. And you're finding the difference between that. And whenever you find the difference between two percentages or two, I guess, markets, that's called a spread. And that's what you're calculating over here. You're finding the spread between the S&P 500 and the 10-year bonds. Okay? So those are the three things that I want you to really consider, really look at, really study before we dive into the